Hey there, everyone, and welcome to the Final Bar. Happy May. It's Wednesday, May 1st. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a cloudy Redmond, Washington. Thanks so much for joining us every weekday after the close as we break down the markets based on the best practices of technical analysis. On a day like today, I am super thankful for the technical toolkit. So much speculation, so much anticipation, so much, picking every single word and tone on Fed Chair Powell's comments with the official statements, with his official remarks, and then the press conference afterwards. At the end of the day, the market having a lot of noise, but by the end of the day, an initial rally after the assessment from the Fed turned into a broad decline going into the end. For 2 straight days now, we've had a steep sell-off, a plunge as we described it yesterday, but certainly giving back all the gains from this afternoon. Right back to the lows of the day with the S&P finishing about 1/3% lower. So any sort of optimism, any sort of big up move fueled by Fed policy changes or impressions about Fed decisions going forward, really not to be by the end of the day, sort of giving back that initial bounce. Great guest today, by the way. Adam Turnquist of LPL Financial has been a frequent guest on the show. Great to have him back to, how we really understand how he's thinking about the interest rate environment relative to the Fed comments today and how that impacts equities and ETFs, which is the core of what we try to do here at Stockcharts.com. With that in mind, let's get to our market recap and see really visually how the markets noisily played through the course of the afternoon today. Before we get there, I do want to answer a poll question we had recently on our social media accounts. Will the next 10% move in Amazon be higher or lower? I love these sort of simple questions that just make you think. What would that 10% move actually be? What levels would that get to? And what's the likelihood of one or the other? One of those is going to happen first. So what would that mean if you're thinking about Amazon as a potential investment, or maybe you hold it in a portfolio or through an ETF? Almost 60% of you saying 10% higher versus lower. That gives you 41% left over saying 4% lower. Let's look at the chart of Amazon and just get a quick sense of what that might mean here. So if I'm looking 10% lower, 10% higher, of course, would take us well above previous all-time highs at 190 and go much further beyond that. We can use the percent change tool to say, yep, we close around 180. 10% down kind of gets us to, well, we'll say around 161, 162. That would actually fill this gap from early February. That's kind of an important gap to pay attention to. That was a gap that a lot of stocks in the growth space featured at the end of January, beginning of February. That was with Q4 earnings season and that initial report, that first report in the first quarter. A lot of those names gapped higher. Arguably, that fueled the continued rise to the peak for the markets in March into April. Amazon, like many others, pulling back now. Amazon, for now, sort of toying with the 50-day moving average. Even today, finished up about 2.3%, but still kind of right at that 50-day moving average. So basically, most of you, more than half of you, saying a new all-time high for Amazon before we get down to 162. I'd probably take tails on that coin flip, I would say, only because, again, for me, I feel like this tactical decline that we've experienced is not done. Based on some of the charts we'll probably show, a day like today certainly not giving a bullish taste in your mouth at the end of trading, with the rally in the afternoon being sold off into the close. But Amazon, from a purely technical perspective, still actually holding ground just fine, right? If you sort of think of this anomaly of a gap lower and close higher, most of the time has been spent between 175 to 185 over the last couple weeks. We're still holding that. We're still holding the 50-day. So overall, constructive momentum with the RSI holding above 40. RSI breaks below 40. I would say the chance of breaking below 160 pretty high, but we'll see for now if that's able to hold. Thanks so much for answering that poll question, by the way. Make sure you follow us on all the socials when you can, especially on X. It's where we put out a lot of our content, and hopefully more social media platforms very, very soon. All right, we've stalled long enough. Let's look at these charts and how they went from okay to great to painful within the course of about a 2-hour period. Here's the S&P sort of treading water into the Fed announcement, and that is very common, right? If you look at the average Fed day, so we have a 2-day Fed meeting, Tuesday and Wednesday. Today's the press conference, the announcement, and then the press conference in the afternoon around 2 o'clock to 2:30 Eastern, really going to around 3 p.m. Eastern is that press conference. There's the initial announcement. There's the press conference starting. There's the upside rally. And as I was listening to Chair Powell's comments, you saw risk assets push to the upside. Cryptocurrencies stocks all sort of bouncing to the upside. From 3 o'clock on, though, it was like the spigot was closed. All the buying power, everyone that wanted to buy did it, pushing the S&P to 5090, and by the close, all of that had been given back. So, the last hour of trading is always pretty interesting because that's where there's usually an influx of institutional investors. Big institutions aren't usually, certainly not on a Fed day, but on an average day, they aren't doing a lot earlier in the day. They're sort of waiting until the last 30 to 60 minutes because you want to minimize the impact on the market because you're moving a lot of volume in some cases. So you try to schedule trades and set them up for the end of the day. As a result, what this is telling you, there's a lot of distribution there in the last hour of trading. Yesterday, it was really in the last 10, 15 minutes where you saw a waterfall decline. Today was really from 3 o'clock on. It was like a tale of two markets, 2 to 3 and 3 to 4. But the closing price is important. And so by the end of the day, the S&P getting down about 1/3% to 50.18. The NASDAQ composite almost identical decline, about 1/3% lower. The Dow did manage to finish barely in the green, but that was after shedding a lot of the initial gains going into the close. Mid caps and small caps also with an aggressive decline in the last hour, but still managing to finish barely in the green. Look at the NASDAQ 100, those 100 leading growth stocks, excuse me, down about 0.7%. And the VIX, on a day that finished lower, actually the volatility managed to come in a little bit, still remaining above 15, which is sort of that line in the sand, that key barrier, in my opinion, between low volatility and more of a pullback range between 15 and 20. The VIX still right around there. Bonds overall moved higher through the course of the day, and it really continued with a rally into 3 p.m. and then coming off. So stocks and bonds had a very similar feel in their charts today, just looking at one day of trading. And that pushes rates down, of course, as bond prices are going up. That means yields are coming down. So the 10-year yield finished today around 4.6%, 5-year point right around the same. Long bond just above 4.7%. The short end of the curve, of course, is still fairly elevated. Bonds in the form of the TLT, which is a bond ETF that we track, was up about 0.75%. No real change for the dollar, although it sold off going into around 3 p.m., regained a lot of that initial sell-off. So the dollar moving inversely from bonds and stocks, and we've talked recently about the dollar index, which is $USD, getting above 107 could be a very negative sign for risk assets. You're seeing that inverse relationship today. Dollar, of course, moving lower when stocks are moving higher, and the opposite. Precious metals having a decent day. When I look at things that actually finished in the green, gold and silver, some of the few macro ETFs we would track to do so, they were both up just below 1% higher for the day. The broader commodity space was down. Energy prices really came off. Energy stocks did not have a particularly strong day. The USO was down 3% today. Natural gas prices down 2% as well. Cryptocurrencies, boy, a lot of noise, but really in a pretty significant downtrend here. We highlighted, I believe, on yesterday's show that 60,000 level, which has now been violated. I was quoted in CNBC a couple hours ago with questions on Bitcoin, basically suggested that a break below 60,000, which I think we've now confirmed, opens the way to further deterioration, maybe down to that 52,000 level. That would be the next key Fibonacci support. 200-day moving average, all right around those levels. So, if you've not sort of thought of some downside targets in Bitcoin, might be a good time to do it. What's interesting is we just had the Bitcoin halving in April, and two things that I've learned from studying the history of Bitcoin halvings. Number one, it doesn't tend to be good for Bitcoin in the short term. Number two, it does tend to be very good for Bitcoin in the long term. So 6 to 12 months later, Bitcoin is usually quite positive, but in the 1 month after that halving, it's actually more noise and usually down rather than up. Looking at the 11 S&P sectors, you have utilities at the top of the list, up 1.2%. Communication services, number 2, up 0.9%. Materials, number 3, up about 0.5%. On the downside, energy leading the way lower, down 1.6%. Tech, down 1%. Consumer staples and consumer discretionary, both down about 0.2%. Look, it was almost even. Financials were flat for the day. We had 5 sectors higher, 5 sectors lower. This was literally a day marked by indecision. You saw that again in the last couple hours with a big spike higher, big spike lower. End of the day, really didn't go anywhere in terms of sector rotation as well. Our market trend model currently being updated, but with the late stage decline, we'll have to see how things played out. But it looks like certainly in the short term, all 4 of my models, again, if the week ended today, would turn negative. I don't update this officially until Friday's close, but I like having this widget available just to monitor sort of the short-term, medium-term, long-term conditions as they evolve through the course of the week. And that's how we design this. This widget updates every day after the close when we update that closing price data. So for now, short-term data, short-term signals looking more weaker rather than stronger. Look at how the Magnificent Seven, in air quotes as always, really split as well. On the downside, NVIDIA down 3.9%. Now, out of all the things I'm going to tell you on today's market recap show, stocks like NVIDIA and AMD down the way that they are is maybe one of the things that makes me feel least optimistic about these markets here, right? These are some of those core names that have done quite well, that have held up when other stocks have been struggling, that are, represent a lot of market cap, certainly represent an AI trade, and represent some of the bellwether groups, right? Semiconductors, sort of the backbone of the modern information economy. So NVIDIA and AMD being sold off doesn't necessarily make me feel particularly good about the markets, but for now, NVIDIA sort of continuing to show some short-term distribution, down almost 4% today. Tesla continuing to struggle, down 1.8%. Apple, third from the bottom there. Amazon, Meta, and Microsoft really having decent days, with Amazon leading the way higher, about 2.3% to the upside. That's after reporting earnings yesterday. Let's go to a daily chart of the S&P 500, see how things played out through the course of trading. As I mentioned, of course, we had that sort of choppy, noisy 2-hour experience around the Fed meeting. But by the end of the day, I'm starting to see more and more a bear flag pattern emerge on the chart of the S&P 500. And just to be clear, what a bear flag is basically, and I'll zoom into the chart here a little bit just so we can see it a little better. A bear flag is where you have an initial decline off of a high usually, but it could be from any sort of downtrend. And then you have this short-term counter trend move to the upside. And it ideally is a parallel channel, right? So we have a downtrend of lower highs and lower lows, sort of on the longer term time frame. But then in the short term, you have this short pattern of higher highs and higher lows. You can draw a parallel trend channel to identify those. And by the way, if you're sort of new to the Stockcharts platform and you're not sure how to make a parallel channel, here's your Stockcharts 101 experience here. What you want to do first, and I'll delete these just to show you what I did. Step one, draw the first trend line. So I'm going to draw this bottom one, which is where I like to start. I'm kind of drawing it there. Then what you want to do is hold the command button on an Apple keyboard and on a PC keyboard. I don't use PCs much. I think it's Alt or one of those keys down around where your left thumb would be. And if you click and drag, you will get a parallel line. That's the way to draw that sort of parallel trend channel. And that's that bull flag pattern that we were talking about. And so for me, this is a negative development if and when, and really if and only if, you break down through that pattern. So the way you generally think of this, going back to your, the basics of price patterns, you have a trend leading into this pattern here. We then have the bear flag, which is this counter trend rally with parallel trend lines. If and when we break below there, and we just closed right at it, I wouldn't call that a break, but if we would continue to follow through tomorrow, I think that could validate it. What that would imply is that whatever move you had going into the pattern, you probably expect a similar move on the downside. And what that would mean in terms of, sorry, I'm just whipping this chart all over the place, but what that would imply would be this. If this was the move going into the pattern, which is like right here, you expect kind of a similar move to the downside. So we'll take a parallel one and draw it there. So there's your downside objective. If that is a bear flag pattern, and if we get the confirmation, and what's absolutely fascinating to me is that gets right almost identically or almost perfectly to that first Fibonacci support level. So, an interesting development so far this week. If we would continue to break down through that bear flag, that measures as an initial downside targets around 48.20. That would be your first Fibonacci support level. I'm going to leave those lines on there for now, because that could be a potential scenario to keep in mind here. The momentum, of course, more negative than positive, with the RSI remaining below 50. That's not a great look if you're bullish. You need momentum to improve from here. A day like today felt like it could have been that day where we did it, but not necessarily seeing it. Continuing on here, talking about some of the key stocks reporting earnings. Of course, besides the Fed, and we're going to talk with today's guest, Adam Turnquist, a little bit about the interest rate environment, about the macro environment, and what sort of ideas make sense given what we learned from Chair Powell and in the discussion afterwards. So I'll leave some of that discussion for my interview with Adam, but I do want to focus on some of the stocks reporting earnings. 3 names what we highlighted were reporting yesterday after the close. Amazon, AMD, super microcomputer, three semiconductor, AI, consumer kind of plays, internet plays, three key names to pay attention to. We talked about Amazon, of course, with our poll question today, and I would say for now, not great because we appear to be putting in a lower high, but not bad, right? We're still above upward sloping moving averages. Really haven't broken the 50-day in any meaningful way and certainly haven't followed through below there. The momentum is holding up still in a bullish range, and the relative strength, of course, is still quite strong. So Amazon, out of all the charts you could bring up of an average S&P chart, you're going to be hard-pressed to find one that looks better than this given the overall deterioration we've observed in April, but really at a key juncture. I think whether it holds that 50-day through the course of this week could be very, very powerful. AMD, I mentioned NVIDIA gapping, trading lower today. AMD really getting killed during trading today, down almost 9% today. This is a gap lower from yesterday's close. As of yesterday, we appear to be trying to make a little bit of headway. We just had peaked above the 160 level. Today, we gap lower, back down to basically retest the lows from April. So we are way down from the previous high around 228. We're now down to around 144. So we've shed quite a bit of value just in under 2 months off of that early March high. The 200-day moving average, while we're still above there, which is good, and the last time we tested the 200-day in October of last year, ended up being a pretty decent buying opportunity. But this is a stock in a confirmed decline with a momentum in a clear bearish range with relative strength deteriorating, and we're right at that 200-day. I think a stock like AMD holding the 200-day could be that could be the question, right? Stocks like this fail to hold it. I think that has very negative implications for the broader market. Another very important AI play, super microcomputer, which has at times been here recently the top performing or the top ranked stock that is in our Stockcharts technical ranking. You can see it's number 2 out of the entire large cap universe today, 99.7th percentile here, gapping down about 14%. Again, the April lows are in play. So with both AMD and SMCI, they gapped lower on earnings today. They're right at the April low, and I think whether they're able to hold that could be pretty important. We failed to hold that. Maybe there's downside to the 200-day. That gets us all the way down to 487, 490, maybe 500 on super microcomputer. That's a long way below 738, which is where we closed today. So I'm concerned at the deterioration, lower highs, lower lows, no real accumulation. And today, earnings could have been the catalyst to recover back above the 50-day moving average. Not to be. That's a negative look from a key theme, AI. Couple names reported before the open today. Healthcare actually getting some names, seeing some positive reaction after earnings. Pfizer is obviously a big yielding name, dividend yield around 6%. That's looked more and more attractive as the price of Pfizer has come down. Remember, dividend yield is basically the annual dividend as a percent of the share price. So as a share price goes from 54 down to 26, you're basically cutting it in half. And as a result, the yield may have been around 3% here. All of a sudden, it's like 6%. Because the stock price has gone down. Even if they pay a consistent dividend, you just have to pay less to get that dividend payment is what that basically represents. Nice gap higher today on earnings, up over 6%. That closes back above the 50-day moving average. Now, we've had a couple false signals where we've gotten above the 50-day and then immediately come back down. Look at how these last couple times when we've traded above the 50-day, that day or at least that week has been the high watermark before a move back lower. And so, previous attempts have stalled out. At some point, Pfizer gets above the 50-day and stays there. I would want to see a little more improvement. The RSI is right at 60, which is where it's tended to top out for the last year and a half. So I'd want to see a little more confirmation, but certainly at least a short-term positive development with Pfizer gapping higher. Some of the travel and tourism names were out today. Not particularly strong outcomes to these charts, as you'll see here in a moment. When you think about the market pushing lower into the close, these are some of the charts that I'm observing through the day today. Norwegian Cruise Lines finished down about 15%. Now, this hadn't been a particularly strong chart, although cruise lines at times had looked really interesting and had really started to improve. I remember looking in late March, seeing Norwegian get above its December peak. All of a sudden starts to seem like there's some life being breathed into some of these less than attractive chart, but today actually coming down and gapping down to the open around 18, closing another $2 lower around 16. That takes us almost exactly to that February low. So we're right at a support level. Short term, you could certainly anticipate at least a bit of a bounce off of support, but I think holding that would be vital, because if you break that, there's not a lot of support levels back down to the November low. That's getting us down to the low teens, around 12.50, maybe $3 a share. Marriott also reported before the open today. Now, not a huge negative outcome. It finished, essentially down 1%. It was a doji candle by the end of the day, which usually is actually a short-term reversal candle, telling you a bit of short-term optimism. But this is a stock that looks kind of like how the market feels. Everything great late March, early April, but on weaker momentum. This is one of those many names flashing a major league bearish divergence, now breaking below the 50-day moving average, now testing it from below with the shooting star candle, closing back below the 50-day, and now we're rotating lower. So certainly in the short term, this feels more negative than positive. Maybe another retest of the 200-day moving average. So we see more and more, I think, echoes right now of what we observed in September and October of last year. A lot of stocks like this ended up finding support at fairly predictable levels. Maybe that's where we're headed for some of these key names. Just to wrap up our market recap, a number of stocks reporting earnings. I'll show you the earnings calendar here in a moment, but two names that I'm watching after the close: Devon Energy, DVN. Energy stocks really got beaten down today on weaker crude oil prices. DVN is really threatening that 50-day moving average, just above $49 a share. We closed just above 50 today, down about 1.5%. Can DVN hold support at the 50-day? Can RSI hold support at 40? If so, maybe this is a pullback, a bull flag pattern, as DVN and other energy stocks start to improve from here. Has to find support first. Finally, gambling names. MGM, choppy today, closed a little bit higher after a weaker open, up about 0.8%. Stock just coming out of the oversold region, which a lot of times provides a counter trend bounce. Interesting to see a potential trade back to the 200-day. We'll see how things play out with earnings after the close. I mentioned the earnings calendar just to wrap up our market recap. We have a lot of fantastic tools that I think could be of help to you. If you go to Charts and Tools in the upper left corner of our website, on the right column, go down to the earnings calendar. This is where you can look at a particular index like the S&P 100 or the NASDAQ. You can look at a particular time frame, see who has recently reported, how their earnings report compared to analyst estimates, consensus estimates are what we're showing here, and then upcoming earnings. Who's reporting coming up very soon here in the next couple days. Make sure you have those earnings dates jotted down in your calendar, or make a note of them, because they can certainly move stocks to the upside and the downside. That's it for our market recap. Before we get to today's guest, Adam Turnquist, a couple quick announcements. First off, we welcome your questions. We're going to do an all mailbag episode Friday of this week. We'd love to answer one of your questions in our next mailbag show. To get your questions in front of us, use email thefinalbar@stockcharts.com. On the Twitters, just tag us in a comment at FinalBarSCTV. And on YouTube, just drop a comment below the video that you're watching. Always helpful if you include a link to the chart that you're looking at. So make sure you click the little link button below the chart on our Sharp Charts or ACP platforms and include that link, and I'll be able to look at the chart that you're asking about. Also, we have a fantastic anniversary special, and it is winding down as we begin the month of May. We wrap our 25th anniversary celebration, April 2024, 25 years old, stockcharts.com. So scan the QR code. You don't have much time left, or go to stockcharts.com/special. If you've never been a paid member of stockcharts.com, this is the time to do it. This is a special sale we usually only reserve for holidays, year-end, Cyber Monday kind of moments. We're doing it now in celebration of 25 years of stockcharts.com. By the way, if you're a current member, you get a fantastic deal to extend your membership. So now's the time to do it. Go to stockcharts.com/special. I want to welcome on today's guest, Adam Turnquist. Adam's the VP and Chief Technical Strategist at LPL Financial, coming to us from the upper Midwest, Green Bay, Wisconsin. Adam, welcome back to the show. How are you faring these days, okay?
Not too bad. Thanks for having me back on. Great to be here talking markets. We've had a volatile start to May already. One day.
So April was a little bit unsettling. So far, May not really making me feel better. You know, quite a lot of noise, of course, with the Fed meeting as expected, but you had an initial spike higher, kind of coming back lower to retest more toward the lows of the day. You know, starting with your chart of the S&P 500, give us a sense of where you're at as we sort of kick off the month of May. What makes sense? What stands out to you for the S&P?
Right now, when we step back, look at the big picture, I think context is key. Longer term, the market trend is higher. You can see that we've had consistent higher highs and higher lows really since those correction lows back in October. We're above a rising 200-day moving average, but we broke a very steep uptrend that propelled the market higher in the first quarter. And now we're suffering the consequences of this pullback. We got a little bit oversold, a relief rally mid-April, and that started to die off right at the 50-day moving average. You can see that even today's price action, we were higher, failed to hold those levels, rejected once again at the 50-day moving average. So I think the big level that we're going to watch to assess how far this pullback goes is going to be the April lows for the S&P 500. If we start undercutting those lows, we don't have buyers coming in on that dip. I think realistically, maybe this drawdown goes to that 4,800 level. That goes back to those January 2022 highs. There's a Fibonacci retracement level, as you're highlighting there, right around that 4,800 level, a little bit above it, and a longer term uptrend. So I think that would be maybe a worst case scenario. When you look underneath the surface of the market and assess how much damage there's been, market breadth is actually holding up pretty well. You can see that in the bottom panel. Still have 70% of S&P 500 stocks above their 200-day moving average. I would still argue leadership remains more offensive than cyclical. Although when you look at RSI, it did roll over at the midline. That's pretty textbook relief rally areas where they go to die, as we like to say. And I do think there's some further downside risk here for the index.
Yeah, it's interesting. I feel like there have been echoes of sort of that August, September, October period, very similar pattern with the momentum, as you highlighted, right, with sort of those counter trend rallies. You know, the Fed meeting, of course, today, a lot of people hanging on Chair Powell's comments in the press conference after. Overall, rates, of course, have been more and more elevated through the course of this year. What's your outlook for the 10-year? What does that mean for investors?
As you segue the flashback to last summer and the market being overbought, yields breaking out above those October 2022 highs, it's been a very similar playbook, almost textbook playbook to what we witnessed last summer. Market very overbought coming into April, yields breaking out through 435. I think that was a pretty good warning shot for equity investors to expect a little bit of a pullback or some profit taking. That certainly played out. And now when we look at yields, you have to be cognizant of the trend. We're above a rising 200-day moving average. We're putting up higher highs, higher lows. So surprises tend to go to the upside here. In terms of overhead resistance that we're watching, there's 471, 488. I do think you could shoot all the way up to retest those prior highs near 5%. I think that would probably propel the market, or at least stall this rally that we've seen in the first quarter for the S&P. And what's been really interesting is when you compare the correlation between 10-year yields and the S&P 500. We try to do that in the bottom panel, just looking at a rolling 3-month correlation. And what's been so surprising this time, when you compare it to last summer, is just the degree of the correlations. Last fall and going into the highs of October for yields, equity markets had a very tough time absorbing that run in yields. And when you compare where correlations are now, basically flat. So we're not suffering as badly on this latest rally. I think part of that has to do with a little bit of less sticker shock when we're looking at the 10-year at today, 460. And I think there's some increased confidence from investors in the economy. You can see that even in the Fed language today in terms of labor market data and some of the manufacturing data. So a little bit different this time, if I dare say that.
It's very interesting. Now, what's so funny is as the U.S. markets have been struggling, there are areas outside the U.S. starting to look a little more different. And China, of course, having a nice rebound off of lows. It almost looks like the U.S. flipped upside down in some ways. China optimism here. What do you think about the charts?
Yeah, I think this is an interesting trading opportunity. We started looking at China early this year when we witnessed, this is the Shanghai Stock Exchange, get all the way down to the pandemic lows. And you had a huge bullish run off that low. If you just step back and think about when we were at those pandemic lows, the entire global economy was shut down. We didn't know what was going on. And that's where price was at just this year. And we've had a significant rally. Of course, very contrarian call. You can see the headlines calling China uninvestable. Of course, as technicians, we look at bottoms and hear those words and we start kicking the tires on trades like this. And it's starting to work out. You can see a head and shoulders bottom formation here, just getting through the neckline as well. When you measure that out, it gets you to kind of a minimum upside price objective around 3,500. For a trade, you could use kind of that 3,400 area as first level of overhead resistance. But for now, there's been a clear trend shift here, a momentum shift. You can see that in that RSI panel on the bottom, where we broke out of this kind of bearish territory. And it's interesting to see just the latest reactions near that midline, holding right above 50 and moving higher. Pretty characteristic of a decent bull market underway here.
An impressive relative strength too, right? I mean, the relative performance, China outperforming the S&P here, which is a very different look than what we saw through much of 2023. Going back to the U.S., Adam, as you're looking at the S&P, of course, coming off of the March high, chopping around quite a bit here. You see rates with the possibility or maybe the probability of them remaining higher for longer. Where do you look for opportunities in this sort of environment? If you see the tactical downtrend, you have some downside targets, do you start to get defensive in this case? Do you look for buying, good, decent companies at a bargain? What's your general mindset in this sort of environment?
We tend to look at barbell strategies. Think of even energy, I guess we could throw in there. It does have some cyclical nature to it, but it has been more defensive and a good hedge against inflation. It's one of the only sectors that's basically flat in terms of correlation to yields, depending on how far you look back. And right now, we're just watching this pullback in energy. It did break out to new highs and now retesting those prior highs. So maybe this is a little bit of a bullish flag formation. We'll continue to assess this pullback, but it has certainly shown some leadership strength over the last, call it, few months. And breadth has been pretty impressive as well. Not just a few energy names driving this. It's been very broad-based. So that would be one area that we like. Communication services is another sector we like that had a bit of a pullback here. And we look at that as more of a buying opportunity than anything else, not a market top. You can see that longer term trend higher and above a 200-day moving average that's also rising. And there's kind of a barbell strategy within the comm services space. You have those more the large cap growth names in there, but more legacy telecom, more defensive areas as well. So I think provides a pretty good balance overall when we're in this kind of market.
It felt like over the last week or two, obviously a lot of earnings in this area of the market, a lot of the big growth names, a lot of internet names over last week, and then this week with some more technology stocks. Any surprises that you saw in terms of the technology sector, communication services, or is this sort of another reset? The AI-fueled boom maybe has further upside. I mean, where are we at in that cycle, do you think?
It's tough to say. I think Meta was a big surprise. Of course, we don't cover the name or have an opinion on the name, but that gap lower was certainly a surprise to many. And some of the commentary they had about profitability of AI. But I think when you look at other earnings with Alphabet and their commentary around AI and what they're doing, kind of offset that, and that's provided a little bit of a bounce here for the sector. But when we look at earnings going out for the rest of the year, it's interesting to see that Meg 7 or Magnificent 7 group, the contributions to S&P 500 earnings start to decline as the rest of the sectors start to participate more. So there's more of a balance that plays into that rotation theme that we're watching carefully. And even in the small cap space, that should bode well if we start to see further broadening in this market.
We only have about a minute left, Adam. I'd love to go back to your chart of the S&P 500. It's sort of given us the short-term pullback, which makes sense. The long-term picture, of course, still relatively strong with we're above an upward sloping 200-day moving average. What would you need to see on a chart like this to really start to think more defensively? Is there a key signal or a breakdown? Is it a break below the 200-day? Is it more negative momentum? What would be sort of that red flag in your toolkit?
Yeah, so we would look at breadth when that starts to deteriorate. For example, if we start seeing less than 50% of the S&P above their 200-day moving average, we like to look at leadership, of course, where's, what's outperforming, and haven't really seen that yet. Utilities have perked up a little bit. I think that's almost an AI play more than anything, and some of the power demand that's gained traction in that space. And then, of course, on the technical levels, if we start undercutting the 200-day moving average, or really that 4,800 level, I would be getting a little more concerned and start really putting in a lower high, lower lows on a consistent basis.
It's tough in this sort of environment to sort of get a good long-term sense and not get scared out of things. Adam, appreciate you so much sharing some of the charts you're paying attention to make sense of these markets. Thanks for coming on a Fed day, and stay warm there in Green Bay, all right?
All right, thanks, David.
That's Adam Turnquist. Adam's the VP and Chief Technical Strategist at LPL Financials, working with a great network of financial advisors to help them make sense of things. What a great benefit to allow them to have some of these technical insights. I really loved Adam's comments about the relationship between the short term, the tactical, the long term. It's so easy on a day, on a week, on a month like we've experienced here to get really nervous about big red days, big down moves. But thinking about the bigger picture, looking at longer term breadth conditions like the percent of stocks above their 50-day or 200-day moving average, as opposed to the percent of stocks above their 10-day moving average, right? Use long-term data to make longer-term decisions, short-term data to use short-term decisions, like Adam Turnquist put that very, very well. Great take there by Adam Turnquist at LPL Financial. Folks, that's it for the show. Thanks so much for joining us every weekday after the close. And again, thank you to Adam Turnquist of LPL Financial sharing some thoughts with us today. For Stockcharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.